Welcome to ForexTV.com's PM Exchange. It's Wednesday, November 7th. I'm Remy Hoki. Today I'm joined by Michael Woolfolk from the Bank of New York Mellon. Michael joins us to discuss the U.S. dollar decline and renewed risk aversion in today's session. Good afternoon, Michael.
Yes, good afternoon, Remy.
Thanks for joining us today.
And thank you for inviting me.
Well, in today's session, we're seeing continued U.S. dollar weakness, and euro dollar has hit another record high. So if you could tell us about the next level of resistance for the major pair.
Well, it has been a remarkable trading session, both in overnight action as well as here in New York. We've seen not only record highs set in the euro versus the U.S. dollar, but in the Canadian dollar versus the U.S. dollar. Multi-decade highs for the Australian dollar as well as sterling. So the dollar is getting sold off across the board. We do have some approximate causes for that overnight. Official comments out of China suggesting further diversification out of the U.S. dollar. Perhaps the U.S. dollar no longer has the role it once did as the center of the financial global system. So I think that what we have to look at is the last technical resistance point for the euro dollar was 145.50, and that was well broken overnight, and there's really very little in the way between that level and 150. 150 really being the next round psychological barrier, likely where many option triggers have been struck and will be protected, at least minimally. So there's very little between where we are now, just below 147, and 150 in terms of the euro dollar. And given the appetite in the market expressed for selling dollars and what appears to be kind of universal dollar pessimism as the Fed prepares to cut rates further, I think that there's a very good chance we could be seeing 150 before the year's out.
Well, Michael, earlier you just mentioned the comments coming out from China about diversifying away from the U.S. dollar. If you could give us your take on those comments.
Well, you keep in mind that China now has over $1.4 trillion worth of foreign exchange reserves, largely held in dollars, and of one form or another, whether it's U.S. Treasuries, agency bonds, or otherwise, they're dollar denominated. I think that given China's growing role in the global economy, it's only natural that they would want to diversify somewhat out of very dollar-centric holdings. Now, putting a political spin on this, it could very well be that in terms of trade negotiations and discussions with the G7 regarding their currency policy, that this takes on more of a political note. Certainly the U.S. is very dependent upon China to take their foreign exchange intervention proceeds and reinvest them back into U.S. securities markets. It's keeping our Treasury market bond prices high and therefore keeping yields low. We have ready access to credit here despite the implosion in the U.S. housing market. So these are political comments first and foremost, and I think that they came at a very indelicate time, or indelicately made a very sensitive time in the market that was very pessimistic on the role of the dollar. The dollar is amidst some crisis right now. I don't think that it will threaten the dollar's role in the global financial system, but I think the dollar is due for further weakness before we're out.
Well, speaking of which, the comments did add to negative sentiment in Asian trading, London trading, and into the New York session. And we're seeing risk aversion in today's New York session with equities down, with the major indexes all down over 1.5%. So if you could give us your ranges for the Japanese yen against the major currencies.
Well, the interesting thing about this, Remy, is that we have so many different trends in the marketplace, very, very strong trends in the marketplace now, including oil now, which has soared well above $80, $90 a barrel. It's even threatening $100 a barrel, and we may see that within the next several trading sessions. I don't think that the market, let alone the global economy, has fully come to grips with $100 oil yet. It certainly has, however, had an immediate impact on the value of such oil exporters as Canada. Canada, Canadian dollar, has rallied to record highs against the U.S. dollar, levels we haven't seen since the Civil War in the U.S. over 140 years ago. Now, why is that? Well, the Canadian dollar is driven by oil prices, certainly, interest rate differentials, growth, all of which have been very, very strong. And there I think that were oil to break above $100 a barrel, this is likely to push dollar Canada below 90 cents a barrel and could trigger some policy actions, namely cutting interest rates on behalf of the Bank of Canada. But we're going to place the range in dollar Canada, let's say 89 cents and 92.5 cents. Now, the reason why I prefaced that before discussing the range for the yen is because yen is a very separate trend in and of itself. At the same time, you have yen carry trades that are being fueled by very low interest rates in Japan, as well as some very low risk aversion. In fact, risk-seeking behavior, taking advantage of low interest rate borrowing. So we see actually the break in dollar-yen below 113 is a very important development overnight. And so we could get as low as 111 within the next several trading sessions, with maybe a top side of about 113.5.
Okay, well, you just touched on dollar CAD, which is one of the commodity currencies. So let's move on to the Aussie dollar. We saw the Aussie dollar hit 23-year highs against the U.S. dollar, and overnight the RBA hiked 25 basis points to 6.75%. So if you could give us your forecast for the Aussie dollar against the dollar.
Well, it's interesting. A number of people, and many of them in the land down under, are interested in knowing when the Aussie dollar is going to hit parity. If the Canadian dollar can manage it, perhaps the Aussie dollar can too. I wouldn't put it past them. Certainly, the Australian economy has many of the same basic fundamental strengths as Canada does. And actually, if you go back over the last 15 years, Australia has sustained growth higher than, on average, the U.S. economy has, which I think is really one of the greatest kept secrets in foreign exchange. Australian growth has been very strong. Their housing market has been strong, but it has not seen the weakness that we've seen here in the United States. Interest rates are high, higher than in the U.S., and likely headed higher. They do have a bit of an inflationary problem, and that consequently, with very high commodity prices being driven in part by strong demand from Asia, China, India, we see that it's really a matter of kind of a secular development, whether or not there's a crisis in confidence. If this risk-seeking behavior stops and yen no longer is fueling these yen carry trades into Australia, you might see a top. I doubt that anything is going to get in the way of seeing 94, 95 cents in the Australian dollar, and although I'd be surprised to see it before the end of the year, I think that parity is likely in the cards for the first part of next year, so long as we don't have a break in confidence.
Well, while we're discussing growth in varying economies, on Friday here in the U.S. we have U.S. international trade data coming out at 8:30 a.m. Eastern Time. So in today's session we've been hearing comments, especially with the French Prime Minister talking about a trade war given U.S. dollar weakness. Yeah. But if you could give us your take on those comments we've been hearing today, and also what you expect to see in the trade deficit data on Friday.
Well, Remy, with all due respect to Sarkozy, he is, of course, a politician, and politicians that talk about currency tend to have political motivations. And I can certainly sympathize with the plight that the recent run in the euro has placed exporters in Europe. It's becoming increasingly difficult to export, particularly the U.S. On the other hand, if you wish to present to China a united front on the part of the G7 that is in favor of flexible exchange rates and against intervention in the marketplace, you have to let markets set prices for foreign exchange open and freely. So we see, looking forward, that regardless of the value of the euro, that European growth is probably going to average about 2% next year, which was very healthy for Europe, given they still haven't fully embraced a lot of the reforms that are needed to push it forward in terms of productivity and growth. I'm not overly concerned that Sarkozy's remark are going to have any material impact on the policy decisions of the ECB. Tomorrow we have the ECB decision, the Bank of England decision. I think that Trichet will maybe touch upon brutal moves in the foreign exchange markets as undesirable. But regarding your comment about trade and the U.S. trade numbers and Canadian trade numbers coming out, I think what you'll see is that the weaker dollar has helped curb this dramatic rise in the U.S. trade deficit over the last several years, and in fact that China will be seen as increasingly the problem, and that a full 1/3 of our trade deficit now is just with mainland China. The pressure will remain on China to continue its nominal revaluation of its currency.
Okay, and last but not least, before we wrap it up, as you mentioned, we do have the ECB and BoE rate announcement tomorrow morning. So if you could briefly tell us what the market should be watching out for from Trichet's comments following the announcement.
Well, we really don't expect anything out of the Bank of England. Of course, if we do hear something, for example, either excessively hawkish or dovish comments, that will clearly impact cable and the euro-sterling rate. I think it's more likely, however, that they decide to be data dependent and still with some risks on the upside for inflation. With Trichet, undoubtedly, he will be making some important statements regarding market stability, about the need to retain confidence in the marketplace. Confidence is key for him, and particularly on our side of the Atlantic, trying to work out our problems in the aftermath of the collapse of the housing bubble will be very important to keep confidence. So brutal moves in foreign exchange is undesirable, and no necessary negative impact from the strength of the euro on the eurozone growth. I think he will mention, and I think he may make some positive comments and soothing comments with respect to kind of the aftermath of the August liquidity crisis.
Okay, Michael, thank you very much for coming on the show tonight.
Thank you very much, Remy.
This has been your Forex News with Michael Woolfolk from the Bank of New York Mellon. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks saw a sharp decline in today's session, with the major indexes ending down by over 2.5%. Wall Street was battered with its second biggest decline in a week. More concerns about the credit crisis fallout from financial institutions, the weakening U.S. dollar, and a record loss from General Motors weighed on consumer sentiment. The Dow Jones Industrial Average fell 360.92 points, or 2.64%, to close at 13,300.02. The Nasdaq fell 76.42, or 2.7%, to end at 2,748.76. And the S&P 500 fell 2.94%, or 44.62 points, to close at 1,475.65. In the fixed income market, U.S. Treasury bonds gained, with the benchmark 10-year note up and the yield down at 4.33%. In energy, NYMEX crude oil futures hit a new intraday record high in electronic trading, but ended down on the session. Crude fell 33 cents to end at $96.37 a barrel. Earlier this morning, the EIA reported stronger than expected U.S. crude oil inventories in the latest week. U.S. crude inventories fell 800,000 barrels to 311.9 million in the latest week. And in other petroleum products, December RBOB gasoline gained to close at $2.4425 a gallon. December heating oil gained to close up at $2.6148 a gallon. Meanwhile, December nat gas lost 23.5 cents to close at $7.681 per million BTU. The API and EIA will release nat gas inventory data tomorrow morning at 10:30 a.m. Eastern Time. Over in the metals complex, gold futures rallied to a new record high, closing at $833.50 an ounce. A broad U.S. dollar sell-off boosted the appeal of the precious metal. COMEX December gold surged $10.10 to close at $833.50 an ounce. Meanwhile, other metals prices ended lower. December silver lost 5.5 cents to close at $15.325 an ounce. December copper fell 8.25 cents to close at $3.25.90 a pound. Meanwhile, January platinum shed $21.40 to close at $1,462.30 an ounce. And December palladium lost $3.05 to close at $376.65 an ounce. Now we're joined by Derek Fry from ONF Futures and Options. He'll give us his outlook for energy and metals futures.
Okay, recapping the action we saw in the energy and metal sectors today, we saw frankly a wild day today, and actually, frankly, most of the wild action that we saw was in the overnight session in both energy and metal sectors. We saw gold in the cash market push all the way up to 845, and we saw crude oil push briefly above 98.50 in the overnight market. Crude oil was in anticipation of today's API report, which of course showed smaller than expected draw, which has certainly taken the wind out of the sails in crude oil. Now, in my business, I know better than to make predictions, but I'm going to stick my neck out and make a rather bold prediction. You will see $90 in crude oil before you see 100, and you will see 100, but you will see $90 first. And same thing in the metals, frankly. You will see $1,000 in gold, but you will see a retracement back below $800 in gold in the fairly near future. The one-way train that has been the selling of the dollar is in the process of reversing as we speak right now. You're going to see that lopsided trade flip over, and we are going to see, at the very least, a dead cat bounce, if not a significant bounce in the dollar as we squeeze the shorts out. So bottom line here is look for the counterintuitive move to begin. It's already begun, frankly. We've seen a 200-point move in the U.S.-Canadian dollar pair, which is also largely tracks the inverse movement of crude oil. So look for a lot more strength in the dollar as the days go on, and the fact that places like CNBC and Bloomberg and all that are trashing the dollar on a daily basis is even more evidence that it's time to get in there and buy it. So play the contrarian. The contrarian, especially in the commodities market, tends to be the right move, and this is the ultimate contrarian play to buy the dollar right now when everyone else is screaming sell. So I encourage you to take a shot at it, because we should see some strength here in the coming days.
That was Derek Fry, head trader at Odom & Fry Futures and Options. Thanks for joining us for today's edition of PM Exchange. I'm Remy Hokie. Tune in tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.